This is one of the newest indicators we've released, and it's built around one of the most important concepts in trading, liquidity sweeps. But instead of simply drawing highs and lows on a chart, this indicator combines Nadaraya-Watson regression, momentum analysis, volatility context, and liquidity tracking into one complete workflow. Most traders think every liquidity sweep is a reversal. Price takes a high, price takes a low, then they immediately enter against the move. But that's not how liquidity actually works. Sometimes a sweep creates a reversal, sometimes it creates continuation, and sometimes it means absolutely nothing. The real question is whether momentum and trend conditions support the reaction. That's exactly what this indicator helps answer. In this video, I'll show you how Nadaraya-Watson regression liquidity sweeps works, how the momentum oscillator is calculated, how liquidity levels are formed, and how to identify the highest quality sweep setups. At the end, I'll also show you a confluence method that dramatically improves the quality of reversal entries. Most liquidity sweep indicators focus entirely on price. They identify swing highs, identify swing lows, then wait for those levels to be taken. The problem is that price alone rarely tells the full story. Momentum matters, trend matters, volatility matters. Without context, traders end up fading strong trends and getting trapped. This indicator solves that problem by combining multiple layers of analysis. It starts with a Nadaraya-Watson regression estimate, measures the slope of that regression, normalizes the result into an oscillator, tracks momentum shifts, records liquidity levels during weakening conditions, and then highlights potential rebound opportunities once liquidity has been swept. The first component is the Nadaraya-Watson regression curve. This creates a smooth estimate of the underlying trend while reducing noise. Next comes the regression momentum oscillator. Instead of measuring momentum directly from price, it measures momentum from changes in the regression estimate. This creates a much cleaner momentum signal. When momentum begins weakening after an extended move, the indicator records liquidity levels at important swing points. These become future liquidity targets. Finally, volatility-adjusted regression bands provide additional context. When price sweeps liquidity and then reclaims the regression value, the indicator can identify potential rebound conditions. Let's look at a bullish example. Price is trending higher. Momentum begins weakening. The indicator records a liquidity level beneath price. Later, price sweeps that liquidity level. However, instead of continuing lower, price quickly reclaims the regression value while momentum turns positive again. The sweep creates a rebound. Now compare that to this bearish example. Price sweeps a prior high, but momentum remains strong and the regression trend remains bullish. Instead of reversing, price continues higher. This is exactly why context matters. Start by identifying the current oscillator direction. Positive momentum favors bullish setups. Negative momentum favors bearish setups. Then watch for liquidity levels created during weakening momentum phases. These become future sweep targets. When price reaches those levels, evaluate whether momentum and regression structure support a reversal or continuation. The strongest bullish setups occur when downside liquidity is swept, price reclaims the regression value, and momentum turns positive. The strongest bearish setups occur when upside liquidity is swept, price loses the regression value, and momentum turns negative. For even better results, combine this indicator with whale liquidity and absorption profile. If a liquidity sweep occurs at the same location as bullish absorption, positive delta, or strong liquidity support, the probability of a meaningful reaction increases significantly. Instead of relying on a sweep alone, you're combining liquidity, momentum, trend, and order flow into a single decision process. That's where the strongest opportunities usually appear.